Welcome to It's the Economy. Credit scoring company CIBIL, we all have a CIBIL score. They've published their latest report and it says credit demand and asset quality, that is, all aspects of credit have improved in the September quarter and continue in the festive month of October. CIBIL finds that whether it is loan disbursal or the amount of defaults, PSU banks have done the best, and then NBFCs and then private banks. CIBIL uses an index called Credit Market Indicator, or CMI, to measure the overall health of the loan market, that is demand, supply, customer behavior, asset quality. CIBIL says that while this CMI has improved in the September quarter versus the March quarter, or the July quarter, the index at the moment is far lower in 2025 compared to 2023 and 2024. Now, why this? To understand all this, I have with us the CEO of CIBIL, Mr. Bhavesh Jain. Mr. Jain, thank you very much for joining us. Let me start with that question. When I saw your CMI, your credit market indicator, you're saying that it was much better in 23-24 and not so good in 25. Why is that?
So, firstly, good morning and thanks for having me on the show, Lata. Yes, there are a few reasons. When we look at the year of 2023 and specifically September 2023, we had a base effect coming out of the COVID, where the portfolio growth rates, as well as in terms of the consumer behavior, the percentages were significantly higher in terms of 2023 as compared to 2022. Now, when we look at the recent quarter of September 2025, it has improved significantly as compared to the previous two quarters. But also at the same time, we have to look at the slowness in terms of the balance growth, and there is a lower growth on credit active borrowers in 2025 as compared to 2023. These are the three main reasons for...
What do you mean by credit active borrowers? I mean, those who already have a loan?
Those who have a loan and who are making payments or looking out for a loan.
Okay. And, okay, let me come to the festive season. I mean, that's the big thing which I wanted to know from you. How much better is it? Is it likely to take this October, November, December quarter to the 24 or 2023 levels in terms of loan demand, in terms of customer behavior?
So, relevant question, I would say, Lata, because post the GST reforms and the announcement in rate cuts and the start of the festive period, we saw a significant spike both in terms of credit demand and credit supply. And which are the retail credit products which saw a significant growth? All linked to the festive mood, I would say. The vehicle loans, the two-wheeler, auto loans, consumer durable loans. If I were to say, these were the three major call-outs in terms of the credit demand picking up. And on the supply side, along with two-wheeler, auto, as well as in terms of your consumer durable, we saw a significant spike in terms of the gold loans. So these were the retail credit products which saw significant growth during the festive period, as well as post the GST rationalization. Okay. And the entire October month, I would say from the last week of September to the entire October month, there was significant growth in terms of both the credit demand and supply.
Okay, now let me ask you an unfair question. I know you won't have November complete data. Your report is as of October. But any guess you can give us from what you know already, whether November showed a much better growth than previous November? Was it just a festive burst or has it continued?
So, Lata, the credit demand has tapered off post the festive period. So the significant spike we saw in the last week of September and October month, in November it has tapered off significantly.
Oh, okay. So we cannot be very sure whether the GST cuts will give us a sustained rate of growth. Maybe I will have to wait for CIBIL's next report, or can you fill us in?
Yeah, so I would say we do expect, Lata, that in the end of the financial year, specifically March, we do expect the demand and supply to go up significantly again. Okay. Because historically, the financial year does bring in a growth in terms of both demand and supply.
Okay. Okay. Yeah. All right. Then in that case, it's a likely positive comment from you. Let me come to the other nuances of your study, which were interesting. You say the PSU bank's CMI was the best, much better than private sector, which is not the way stock market guys understand. Why did they do so much better? On what parameters?
Multiple things. One is that post-COVID, the PSU banks have been focusing a lot on mortgage loans and specifically on the housing loan. So they have been building nicely that book of housing loan over the last 2 to 3 years. The growth rates in terms of the portfolio balances have been on the higher side. Plus, in terms of because of the base effect, through the door population selection, all those parameters have added and helped the PSU banks where their growth rates are significantly higher. Their portfolio quality have improved significantly. So those are, when we look at the CMI 4 pillars, PSU banks have performed well on all the 4 parameters, and hence their CMI is the best.
Okay. Well, the other interesting nugget I picked up in your report is that semi-urban areas actually are doing the best, both in 2024 and in 2025. They are accounting for the highest share of loans of credit. Can you fill us in? I mean, what kind is this? Tier 2, Tier 3 cities? Which geographies? Any detail you can give us on this?
Absolutely. So we have to look at few factors which has led for last 3 4 years in the semi-urban and rural location growth rate. One is the increased branch penetration of banks and NBFCs, the digital penetration, and most important is in terms of the headroom available for credit penetration in these geographies. And to your specific question, Lata, it's largely the tier 2, tier 3, tier 4. And if I have to call out one geography, a set of geography which would stand out, would be locations with a population less than 1 lakh. And this is very encouraging sign to see that credit penetration is really going down to the grassroots levels.
Okay. No, we visually see many of the tier 2, tier 3 cities look much better when we visit them. You know, when you look at Jaipur or Indore, I mean, the growth is very, very palpable when you visit the cities. So maybe a special study is needed to understand that, it's not metro, but semi-urban, where perhaps India is growing the fastest. Let me come to the issue of what is not done well. Credit cards, they're in actual contraction. Isn't that a bit dangerous?
Yeah. So what's not done well for us in terms of the retail credit market? Yes, credit card, the originations is declining year on year, and we have seen it for last 3 to 4 quarters that the credit card originations are going down year on year in terms of the growth rates. But what's good in terms of the credit card is the portfolio quality have improved in the recent quarter. One. Second is in terms of the utilization levels have gone up, as well as the credit card balances have gone up. So yes, there is a concern in terms of the new credit card issuance growth rate, but the portfolio quality have improved, I would say. 2 3 other areas for us to watch out in terms of making sure that the utilization level is managed by the consumers on their credit card in their wallets.
Okay. So what you're saying is this is not a question of India's growth, retail growth getting challenged. It is more a cleaning up of portfolio.
Yes.
Okay.
Yes.
In that case, that's a positive. Where are you worried? I think you're worried about the small micro loans. That's where you're seeing higher defaults.
Yes. So, Lata, if you look at the aggregate retail credit portfolio, it has improved significantly. Okay, from the 2%, say, to few years back, it has come down in the latest quarter to 1.6%.
Oh.
Okay, so when we look at across the secured loans, whether it's housing, property loan, the portfolio quality or delinquencies have improved for good. Even on the unsecured side, personal loan, credit card, consumer durable, it has all improved. But there are few areas which I would call out. First one is micro LAP, which is the less than 10 lakh loan against property. Second is the small ticket housing loan, which is less than again 25 lakhs. And third is the commercial vehicle. So these 3 areas where actually the 90 plus coincidental delinquency have actually increased. Now, these are the 3 areas I would call out where the delinquencies have increased. Rest all portfolios the delinquencies have improved. The aggregate retail credit portfolio has improved significantly.
Okay. Oh, that's very important. Aggregate credit quality, very good, but pockets of under 10 lakh MFI loans, LAP loans, and under 25 lakh housing loans are the only small areas of problem. We're completely out of time, but very quickly, your volume growth in origination shows, a fall, but value growth has done very well. So should we understand there is a premiumization? Fewer people, the rate of growth of loan taking is not high, but the same people are taking larger loans.
Yes. So we see a significant shift in terms of lenders going after high ticket loans, whether it is an housing loan, auto loan, or personal loan. The growth rates in terms of the higher ticket sizes is significantly higher than the lower ticket sizes. So we see a big focus in terms of higher ticket size as well as in terms of existing to credit and existing to lender concentration going up in the recent times.
Okay, well, we'll have to leave it at that, but that's a very useful insight that there is a premiumization and there are more of the loans are going to well-off borrowers as well, that semi-urban is doing very well. Overall loan quality excellent. All that are extremely positive. I'm only worried about the fact that you say in November loan growth has distinctly shown a fall off the cliff. But we will wait for the next CIBIL report on that. Thank you very much for joining us, Bhavesh Jain. We have to take a break on that note. Thereafter, it will be time for Chartbusters.